Here's everything you wanted to know about after-hours trading,
but we're afraid to ask.
After-hours trading exists, as you might expect, to accommodate trading of global events like natural disasters, changes in foreign markets, company earnings reports, or basically any other news that could impact the stock price outside of regular hours. Extended hours trading has always existed for wealthy clients. It's just smaller exchanges wanted to attract more clients, so they started offering pre-market trading, and the rest is history. Pre-market morning trading starts at 4 a.m. and ends at 9:30 a.m. Although some brokerages cut off at 9:20 or 9:25 just before the market opens. Most US brokerages don't allow pre-market trading until 7 a.m. Why? Staff and compliance. Few brokerages want to pay a team to be in at the office at 4 a.m. I certainly don't want to go to work at 4 a.m. Post-market trading starts at 4 p.m. and ends at 8 p.m. Some brokerages, like Schwab, even allow 24-hour trading of select securities. Check your brokerage's documentation for their exact hours and offerings. In after hours, the liquidity can be very low, and market orders take the best price, and the best price after hours can fluctuate wildly. So only limit orders are allowed. For more context, check out the FINRA Rule 5320, also known as the Manning Rule. Simply put, there are no market makers in after-hours trading. Trades during extended hours are executed directly between buyers and sellers using electronic communication networks, ECNs. ECNs match orders, but liquidity can be sparse. Even if your bid or ask is near the last traded price, there may not be a match, meaning no buyer or no seller at that price, leading to slower and less predictable trades. Is level 2 accurate? Kind of, from a certain point of view. For those unfamiliar, level 1 shows the latest bid and ask price, essentially the most readily available quote for the typical investor. Level 2 shows the bid and ask ladder, the price and quantity of bids and asks of each market maker up and down the bid-ask chain. Essentially, this is a deeper look into the order book. However, only the minimum quote size has to be shown, meaning if a market maker wants to sell 10,000 shares but will take 1,000 shares at a minimum, they only have to report 1,000 shares on level 2. This can become a problem after hours when liquidity is very low. Let's say a stock is trading at $1 and the level 2 ladder shows someone is selling 100 shares at $1.05. Another seller is selling 100 shares at $1.10. And finally, 50,000 shares at $1.50. You might look at this ladder and think, all right, I can sell them 100 shares at $1.05 and 100 shares at $1.10, and then I have a buyer at $1.50. However, those 100 share blocks are the minimum quote size. So there are at least 100 shares for sale at $1.05. How many? Well, slap the ask and find out. That's the only way you'll know for sure. So the next time you're browsing stock twerps and you see about to explode ask is super thin, they seriously don't know what they're talking about. Let's talk a moment about what you should look for in a brokerage. Any brokerage worth their weight in salt has after-hours trading, usually starting at 7 a.m. All the popular brokers, Schwab, Fidelity, Merrill, etc., all have after-hours trading. Some brokerages, like Interactive Brokers, have pre-market trading that starts at 4 a.m., but in our experience, it's better to just get 3 hours extra sleep. As I mentioned earlier, double-check your brokerages after hours. They can vary from brokerage to brokerage. I would strongly suggest using a brokerage that has good till canceled orders that can be executed in after hours. Look for the abbreviation GTC plus EXT or good till canceled extended hours. As for trading, you must specifically mark your trades as aftermarket trades. This is very important to understand. If you're holding ticker WOW and have a normal sell order at $1.15, if that stock moves to $1.20 in pre-market trading, your order will not be executed. Will not be executed. Will not be executed. When placing the trade, depending on your brokerage, there will be a time frame option. Look for pre-market, post-market, extended, EXT, etc. When actively trading after hours, it's also important to check the after hours price. The day's closing price may or may not be the price that is currently trading in after hours trading. Something else to note, Some brokerages do not trade fractional shares after hours. So maybe you have a stock with dividends reinvested and you now have 15.3 shares. Depending on your brokerage, you may only be able to sell 15 shares after hours. Again, check your brokerage's documentation. I also want to point out that the candlestick charts you get from charting software online usually don't include the pre-post-market activity. However, you should be able to find this activity in your brokerage's trading tools. And finally, along the same vein, the historical price listings you'll find online don't include pre or post-market activity. So assume a ticker traded up to $1.50 during pre-market, and then opened at $1, climbed to $1.20 during normal hours, and closed at $1.10. On the historical data, you'll see the open at $1 and the close at $1.10, but the high will only be $1.20. The $1.50 pre-market trade is not included. Alright, that's everything about aftermarket trading you'll need to know. You know the drill? Like and subscribe. And if you like this content, check out our event-based, risk-aware trading platform at gravityanalytica.com. Happy trading.